Hello and welcome back to Talk Tickers. It is Tuesday, January 20th, 2026. Today we are stripping things back to the absolute basics. No AI hype, no biotech moonshots.
Yep.
We are looking at the nuts and bolts of the economy, literally. We are talking about Fastenal, ticker symbol FAST.
The blue team.
Oh.
You know, the folks who drive those white trucks and keep the factories of America from literally falling apart.
Exactly. And, usually a fastener distributor is about as exciting as watching paint dry. But Fastenal is different because they're the canary in the coal mine.
Right.
They report early, and they touch almost every sector of the industrial economy. So if you want to know if a recession is starting, you don't ask the Fed, you ask the guy selling the screws.
That is the theory anyway. And this particular earnings report for Q4 2025, it's fascinating because you've got this total collision of narratives.
How so?
You have a management team that is just pounding the table, claiming a strong recovery, promising double-digit growth. And then you have the market, which took one look at this report and absolutely hated it.
It was not pretty. The stock got hammered in the pre-market, down over 6%. It clawed back a bit, but still closed down more than 2.5% on massive volume.
Yeah, volume was huge, right? 2.5 times the normal average. The market is sniffing out conflict.
A disconnect.
Totally.
Yeah.
The headline numbers look okay on the surface, but when you dig into the mechanics, specifically the margins and this whole tariff situation, things get messy. This is a story about a company trying to sprint uphill while, wearing a backpack full of rocks.
That's the disconnect we need to figure out today. Is this a buying opportunity in a misunderstood giant, or is the canary actually gasping for air?
And we have a new cast of characters here. A brand new CFO, Max Tunnicliffe, on his very first earnings call.
Yeah, thrown right into the fire.
So let's see how the rookie did. Let's start with the scorecard. Give me the headline numbers.
Okay, so on the surface, it looks fine. They reported GAAP earnings per share of 26 cents.
That was exactly in line with what Wall Street expected, and it's up about 12.1% from last year. So the bottom line is growing. They are making money.
Okay, so earnings are solid. Where did they miss?
The top line, revenue. It came in at $2.027 billion. The analysts were looking for $2.04 billion.
So a $13 million miss.
Yeah, on a $2 billion quarter, it's not a disaster. It's almost a rounding error. But in this environment, any miss gets punished. But the reason we saw that heavy selling wasn't the revenue. It was the gross margin.
Let's pause there because gross margin is like the heartbeat of a distributor. It's the difference between what Fastenal pays for a bolt and what they sell it for.
Correct. It's their pricing power. And in Q4, that power slipped. Gross margin came in at 44.3%. That is down 50 basis points from 44.8% a year ago.
50 basis points is half of 1%. I feel like to a normal person that sounds, insignificant. Why does Wall Street freak out over 0.5%?
Because when you're moving billions of dollars of hardware, 0.5% is massive leverage. It implies friction. It means either your costs are surging and you can't pass them on fast enough, or your customers are squeezing you for lower prices.
It calls the quality of the earnings into question.
That's it, exactly. Sure, they grew EPS by 12%, but they did it partly by cutting, administrative costs, not by selling products more profitably.
So they saved their way to the bottom line number rather than earning it through premium pricing.
Exactly. And that is just not a sustainable way to grow forever.
So let's unpack the why. Why is a dominant player like Fastenal seeing its margins shrink? The new CFO, Tunnicliffe, he laid out 3 specific headwinds. Walk us through them.
Okay, so the first one is structural, and it's arguably the most important for the long-term thesis. It's called customer mix. Fastenal is aggressively signing what they call key accounts.
These are the whales,
Yeah.
the big national contracts.
Right. Global 1,000 companies. Now, landing a whale is great for revenue growth.
Right.
That's how you get that 11% sales bump we saw. But whales, they have leverage.
They demand bolt pricing.
Big time. They aren't paying the same price per bolt as the local machine shop down the street. So as Fastenal shifts its business model toward these giants, their average margin just, naturally drifts down. They're trading margin percentage for volume dollars.
Which makes sense strategically. You want the volume, but it drags down the one metric that investors really obsess over. Okay, what's number 2?
The second was a technical accounting issue. Inventory timing, inflation. We can kind of gloss over it as noise. But the third one is a fascinating signal about the broader economy.
It's about supplier rebates.
Yes.
And the CEO, Dan Florness, he had a very colorful description for this. He said it was crickets.
Crickets. Total silence. That is not what you want to hear.
Explain how these rebates usually work.
So it's a standard game in distribution. Suppliers, the companies making the drills, the gloves, all that stuff, they want Fastenal to push their product. So they set volume targets. They say, hey, if you sell X amount this year, we'll cut you a rebate check in Q4.
A kickback for performance.
It is. So usually Q4 is this bonanza of checks coming in, which boost Fastenal's margins right at the end of the year.
A nice little true up.
Exactly. But this year, nothing. Florin has said suppliers were either so far behind on their sales goals that they just gave up, or they'd already hit them and stopped pushing. But the net result was zero.
That feels like a huge macro signal. If the suppliers aren't paying rebates, it means the suppliers themselves are hurting.
Precisely. They're tapped out. It signals that the manufacturing base upstream is really struggling. They don't have the gunpowder, as Florin has put it, to chase volume. So a line item that was a positive last year just flipped to a negative this year. And that swing hurt the margin.
So we have a margin squeeze from big customers, and we have suppliers too broke to pay rebates. That paints a pretty grim picture. And that brings us to the elephant in the room for 2026. Tariffs.
The T words. Yeah, it dominated the call.
They spent a lot of time on this, but I want to understand the mechanics. Usually you think inflation is good for a distributor, right? They just raise prices. Is that what's happening?
Well, it's a double-edged sword. On one hand, yes, inflation helps the top line. They said pricing contributed somewhere between 300 and 340 basis points to their growth this quarter.
Okay.
So the stuff on the shelf costs more, so revenue goes up just by standing still.
But at some point, high prices kill demand.
That is the squeeze. And Fastenal made a really, really important distinction here between fasteners and non-fasteners. This is critical.
Break that down. Why does it matter if it's a nut or a power drill?
It's all about control. Fastenal is, at its core, a fastener company. They source the steel, they work directly with the factories, they have visibility. If a tariff hits steel, they know exactly what it costs, and they can pass that directly to the customer pretty efficiently.
They control that supply chain.
Right. But they don't make the DeWalt drills or the 3M safety glasses.
They're just a reseller for those.
Exactly. For non-fasteners, they're at the mercy of those brands. And Florin has noted something pretty disturbing. He said suppliers are raising prices across the board using tariffs as air cover.
So even if a product isn't directly impacted?
Even then, the supplier raises the price anyway to cover their own inefficiencies or just to pad their own margins. It's the inflation psychology. Everyone's raising prices, so why not?
And Fastenal is caught in the middle.
They are. They're trying to push back, telling suppliers, prove to us that your cost went up. But often they just have to take the hike. Then they have to turn around and have what they call frank conversations with their customers.
I love that phrase, frank conversations. That is polite corporate speak for an argument about money.
It is absolutely an argument. Look, Mr. Customer, the price of this glove just went up 15%. You can either pay it, or we can switch you to a cheaper private label glove that we source ourselves.
That sounds like so much friction. I mean, if you're a sales rep, you want to be selling new deals, not arguing with existing clients about price hikes.
That's the risk. It slows down the sales cycle. It's a distraction. And in a sluggish economy, customers are way more likely to fight back.
Speaking of sluggish, we have to talk about the holiday excuse. It feels like every time a company misses in Q4, they blame the calendar. Fastenal said the midweek timing of Christmas and New Year's hurt them. Is this legitimate, or is it just the dog ate my homework?
I am usually very skeptical of the calendar excuse, but in this case, the data actually supports them. And this is where you see the power of their data. Florin has shared some really granular info from their vending machines.
Right. This is the benefit of having that digital network. They can see exactly when the factory lights go out.
Exactly. They tracked activity day by day. He said that typically, over New Year's week, about 10% of their customer base shuts down completely. This year, it was 20%.
Double. That's a huge jump. Why?
It suggests manufacturers were looking for a reason to save money. If demand is soft and the holiday falls on a Wednesday, why not just shut down for the whole week? You save on labor, you save on overhead. It's a quiet way to cut costs.
It's a sign of that sluggish industrial environment.
For sure. If factories were running hot, they wouldn't shut down for a week just because it's convenient.
So, okay, a messy quarter, margins are down, customers are shutting down factories, and yet management sounded incredibly confident looking forward. Dan Florness was talking about double-digit growth for 2026.
This was the most controversial moment of the call. An analyst from Baird actually had to stop him to clarify. He asked, Is that official guidance? Are you promising us double-digit growth?
And Florness kind of danced around it, right?
Oh, yeah. He called it momentum. He said, that's how we're thinking about the year. But think about the audacity of that. They admit the industrial economy is flat. Production isn't growing. So for Fastenal to grow 10 or 12%.
They have to steal all of that market share from someone else. They have to eat the competition.
Exactly. It is a bet purely on execution. They believe their model is so superior that they can grow, even if the pie itself is shrinking.
And the core of that model is the digital footprint. We see this term everywhere. 62.1% of sales are now digital. But we're not talking about our website, are we? This isn't Amazon.
No. When Fastenal says digital, they mostly mean their FMI program, Fastenal Managed Inventory. These are the vending machines and the sensor bins that are physically inside the customer's facility.
Explain the stickiness of this, because they signed almost 6,000 new devices this quarter alone. Why is a vending machine a moat?
Okay, imagine you run a factory. Fastenal comes in, they install a machine that dispenses gloves, drill bits, batteries. Your employees just swipe a badge to get what they need. Fastenal monitors the levels remotely and refills it before it ever runs out.
It's convenient.
It's way more than convenient. It's integrated into your workflow. Roughly 46% of their total sales physically pass through those machines. So to fire Fastenal, you can't just send an email. You have to physically rip out thousands of vending machines from your plant floor, find a new supplier, set up a new system, retrain your entire staff.
That's a total nightmare. No plant manager ever wants to do that.
Exactly. It creates massive switching costs. That is why they're so confident about raising prices for tariffs. They know their customers are effectively captive. If you need a bolt to keep the line running, and the bolt is right there in the machine, you are not going to drive to Home Depot to save 5 cents. You just take the bolt.
But building that captivity is expensive, and that leads to the capital expenditure guidance. They're planning to spend a ton of money in 2026.
A massive jump. They're guiding for $310 to $330 million in CapEx. For context, in 2025, they spent about $230 million.
Wow.
That is a nearly 50% increase in spending right as the economy looks like it might tip into recession.
That is bold. Some might even say reckless. Where's the money going?
A lot of it is going into a new master hub in Atlanta. They're building this massive infrastructure just to hold inventory. They're also upgrading their trucking fleet and their IT systems.
So while everyone else is pulling back, they are doubling down on physical stuff.
It's a counter-cyclical bet. They are betting that when the smaller distributors get crushed by tariffs and supply chain chaos because they don't have the cash, Fastenal will be the last one standing with a warehouse full of bolts.
Which brings us to the read-through. If you don't own Fastenal stock, why should you care about the price of a bolt in Atlanta?
Because Fastenal is the proxy. We haven't seen earnings yet from the big industrial giants, the Honeywells, the Caterpillars, the Eatons, but Fastenal feeds all of them. If Fastenal says production is sluggish and tariffs are causing friction, you can bet your portfolio that those other companies are going to see the exact same thing.
So Fastenal is the leading indicator.
Yes, and the signal is the underlying economy is weak, but the strong players are using that weakness to consolidate power.
You know, before we get to our trade idea, I have to mention one truly bizarre moment from the call. Amidst all this talk of margins and tariffs, CEO Dan Florness went on a bit of a tangent.
Re-email.
The email. He started reading an email he found from January of last year about snow in Houston, and then he pivoted to giving a shout out to the University of Wisconsin River Falls football team.
It was very Uncle Dan at Thanksgiving.
It was. But does that worry you? The stock is tanking, margins are down, and the CEO is talking about Division III football.
You know, it shows he's comfortable. Fastenal has a very unique culture. They promote from within, very family business vibe. I think he was trying to project calm. He's saying, look, we've seen this before, we're fine. But honestly, on a day where the stock is down 6% at the open, Wall Street probably wanted less football and more explanation on those gross margins.
That's a fair point. It's hard to cheer for the Falcons when your portfolio is in the red.
Okay, let's pivot to the actionable part of this deep dive. We've analyzed the past. Let's look at the future.
All right, disclaimer time.
Yeah.
We are just two voices in your headphones. Yeah. This is not financial advice. Please do your own due diligence.
Understood. Now, hit me with the concept. You're calling this the blue team bunker trade.
That's right. The blue team is Fastenal's nickname, you know, the blue trucks. The bunker is what they are building with that $330 million in CapEx. Here's the thesis. We are entering a period of just pure supply chain chaos. tariffs, inflation, uncertainty. In that environment, cash is trash and inventory is king.
You want to own the physical stuff. You want to own the company that has the physical stuff. Fastenal is spending hundreds of millions to build these massive hubs to basically hoard inventory. They are becoming a private central bank for industrial parts.
So the trade is to go long Fastenal.
Long Fastenal, but here's the twist. You pair it with a short on the generic industrial sector, like the XLI ETF.
Wow, that is aggressive. You're betting on the distributor against the actual manufacturers. Explain the logic.
I'm betting on the leverage. Think about the small local distributors. They don't have the cash to stock up before tariffs hit. They don't have the leverage to demand those frank conversations with suppliers. They are going to get crushed.
And Fastenal will take their market share.
They'll be the only ones who actually have the product on the shelf.
And the manufacturers, their customers, are the ones who have to eat the higher costs.
Yes, exactly. The manufacturers are the ones who suffer from the margin squeeze because they can't raise prices on their end products as easily. But Fastenal, with its vending machines, just passes the cost along. It's an inflation protection racket disguised as the bolt distributor. The customer has to buy the bolt from the machine because the machine is already in their building.
It's a captive audience play. The moat protects them from the macro headwinds that hurt the rest of the sector.
Exactly. The blue team builds the bunker, fills it with inventory, and everyone else gets left out in the rain.
I like it. It's cynical, it's aggressive, and it capitalizes on the exact dynamic we discussed, this consolidation of power during a downturn.
It's the only way to play a sluggish market. You have to find the winner who takes the whole pie.
So, to wrap this up for you, Fastenal missed the quarter because of some short-term noise rebates and mix shift. The market punished them. But under the hood, they're locking in customers faster than ever.
That is the takeaway.
Yeah.
The digital moat is getting wider. The margin compression is painful right now, but it's the cost of acquiring that long-term dominance.
And you should keep an eye on those frank conversations. If Fastenal can push price increases through in 2026 without losing customers, the stock is probably cheap right now. If customers balk and start ripping out the machines, then the thesis breaks.
We'll know in about 90 days.
We certainly will. Thanks for listening to Talk Tickers. Check your portfolios for tariff exposure, folks. It's going to be a bumpy year for anything made of steel. We'll see you next time.